Hello, everyone. Welcome to the Gold Breakdown. Today is December 24th, Christmas Eve. First of all, I wish you a Merry Christmas. Whether you're eating turkey with your family right now or you're still on the front lines watching the charts, I hope you're in a good mood tonight. Why do I say be in a good mood? Because the market gave us a massive Christmas bonus, or rather, a massive shock. Just as everyone was gearing up for the holidays, the precious metals market staged a velocity squeeze. According to the latest market data, the price of gold has officially cleared the $4,500 psychological handle. And our offensive lead, silver, was even more of a standout, reclaiming $72 in one fell swoop. What does that even mean? Folks, this isn't just a run-of-the-mill bull market, this is an epic breakout. Now, many on the street are cheering, calling this a fundamental victory, the inevitable result of a sliding dollar and geopolitical heat. That's right, those are the catalysts. However, a key point most people are missing is that the reason it's run so wild over the last 48 hours is due to an invisible driver that most are ignoring. A dedicated year-end amplifier. Behind this frenzy, there is an invisible hand taking advantage of the holiday vacuum to aggressively squeeze the shorts. However, just as everyone is riding the high of these profits, two massive risks are quietly closing in. One is the cold reality of Wall Street's playbook, and the other is a horror technical signal that just flashed with an 80% accuracy rate. In today's Christmas special, I'm going to cut through these dizzying candlesticks to show you the truth at the eye of the storm. We're going to talk about the looming January 8th scare, the silver that's vanishing from Chinese vaults, and why I believe 2026 will be a game for the brave. This video is a bit of a deep dive with plenty of gems, and it's critical to whether you keep these two-day gains, so please watch until the end. First, let's break down the anomaly of this two-day surge. Why did gold blast through 4,500 inches one go? Why is silver flying towards 72 as if gravity doesn't exist? Beyond the macro narrative of a weak dollar and safe haven demand we've hit on before, the immediate short-term reason boils down to two words: ghost town. Yes, you heard me right. It's because nobody is home. Now that the Christmas break is here, most Wall Street traders and London market makers have headed to the Alps for skiing, or the Caribbean for the sun. The entire market has shifted into what we call holiday mode. Capital has pulled back, and trading volume has cratered. At times like this, market liquidity becomes paper thin. What is thin liquidity? Let me give you an analogy. The normal market is like an ocean. You throw a stone into it, a large buy order, and the surface barely ripples. But right now, the market is like a bathtub that's been drained, leaving only a shallow skim of water. At this moment, if you throw that same stone in, the splash might hit the ceiling. Imagine if an institution wants to buy $100 million in gold. Usually there are enough sell orders to absorb it, and the price might only move by $1. But in this liquidity-starved environment, that same $100 million order hits the tape, and because there aren't enough sellers, the price can gap up $10 or more instantly. This is the liquidity premium. In this environment, silver's performance is particularly wild. You have to remember the silver market is relatively small, only about 1/9 the size of gold. In normal times, it's volatile, but right now, it's basically a dinghy lost in massive swells. The same amount of capital hitting the silver market has a much more violent impact on price than it does on gold. The current silver market is the bathtub where the water has almost run dry. What's even scarier is that this low liquidity triggers a short squeeze mechanism. However, because market depth isn't there, they can't find a counterparty even if they want a stop loss, so they are forced to cover at even higher prices. This short-on-short stampede effect is being perfectly illustrated in silver. Therefore, the market moves of the last 2 days are less about fundamentals and more about a short-term game of sentiment versus probability. Price discovery is distorted in the short term. Now that we've covered the technical why behind the surge, it's time to flip into risk alert mode. Even though I'm a long-term gold bull, at these levels, I have to point out the traps beneath our feet. After the party, we're about to face two reality checks. The first risk, a dead cat bounce or oversold rally in the US dollar. This signal needs your full attention. Let's look at this chart comparing the dollar index to gold. As you can see, the green line, the DXY, has recently dropped to a floor. However, listen closely. According to Bank of America's latest technical report, an extremely rare signal has surfaced. On December 19, the US dollar index printed the famous golden cross. What does this mean? Simply put, the short-term moving average crossed above the long-term moving average, which is usually the battle cry for a trend reversal and a bull run. You might say, golden crosses happen all the time. No, this one is different. This is only the 39th time in history the DXY has seen a golden cross. According to historical backtesting, the probability of a dollar rally is as high as 68% to 79% in the 20 to 60 trading days following this signal, with an average move of about 1.22%. That's not even the scariest part. What's more notable is that this is an extremely rare type of golden cross, the 16th one since 1970, to occur while the price is below the 200-day moving average. Under this specific technical setup, the probability of a dollar Jedi counterattack jumps to 80%. What does this tell us? It means there is a high statistical probability of a strong technical bounce in the greenback in the coming weeks, and we all know gold and the dollar are on a seesaw. If the dollar giant stands back up, current gold prices are bound to face correction pressure. This is a high-conviction short signal, and bulls must stay vigilant. The second risk is one I really want to emphasize: the passive smash on January 8th. This is a very professional piece of insight. Every year in early January, the world's largest commodity index, the Bloomberg Commodity Index, undergoes its annual rebalancing. The core logic is simple. Sell the winners that have rallied the most and buy the losers that have dropped, bringing weights back to target. Think about it. Who are the biggest winners of 2025? Without a doubt, it's gold and silver. Their gains have been so massive that they are now heavily overweight in the index. According to BCOM rules, hundreds of billions in passive funds tracking the index must mechanically dump gold and silver starting January 8th. What does this mean? It means early January will see a wall of selling pressure hit the market regardless of price. This could be the signal for a major round of profit-taking. So, if you're a short-term trader, be extra careful around January 8th regarding a technical drawdown. Hearing this, are you starting to panic? Do you think 4,500 is the top? Think it's going to crash in January? Wrong! Dead wrong! The risks I just mentioned are short-term noise. If you zoom out, this pullback isn't even a ripple compared to the supercycle in precious metals. Gold and silver remain the undisputed leaders of this market. Why do I believe any subsequent dip is a buying opportunity? Because this time is different. Silver, specifically, has all the ingredients for a repricing. Physical silver stocks are being drained at an alarming rate. This isn't hype. This is a physical supply crunch. Let's look away from Wall Street and toward the east to China, the world's most critical physical silver market. Right now, Chinese silver stocks are flashing red. This isn't fear-mongering, it's hard data. According to tracking data from the Shanghai Futures Exchange, Shanghai's reported silver inventory has hit a 10-year low following record-breaking exports. You have to understand, China is a powerhouse of silver production and consumption. What happens when China's vaults run dry? It means a critical link in the global supply chain has snapped. When Chinese supply falls, the global market feels the shockwaves immediately. This isn't a temporary glitch, it's a structural deficit. In fact, according to the Silver Institute, the global market has been in a supply deficit for 5 consecutive years. We are facing a terrifying time lag here. On the ground, inventory is vanishing before our eyes. But what about the mines? They are completely unable to keep pace. Most new silver projects take years to move from exploration to actual production. According to current roadmaps, most new capacity won't be online until 2027 or 2028. In other words, for the next 2 to 3 years, we are going to be starving for supply. Demand is exploding, inventories are bottoming out, and new supply is stalled. This tension will become the new normal for the next few years. This is the fundamental reason silver must be repriced. Beyond supply and demand, there's a sexy indicator hinting at silver's explosive potential, the gold-silver ratio. If we open the long-term chart, you'll see the ratio has pulled back to a major long-term support trend line. This is a pivotal spot. While the ratio is lower than its recent peak, if we look at the long-term historical average, usually between 40 and 60, silver is still dirt cheap relative to gold. What does that mean? It means if the market simply returns to the mean, adjusting the ratio back to 60 or even 50, silver would need to rally massively just to catch up, even if gold didn't move a cent. This is what we call catch-up growth. To put it simply, gold is the king, but silver is the sleeping knight. And right now, the night is waking up. Finally, let's recap today's take. Current frenzy, gold 4,500, silver 72, the result of macro drivers amplified by holiday liquidity drying up. It was a perfect storm. Short-term warning. Through this holiday season and early January, we need to stay sharp. The dollar has a rare 80% win rate, golden cross, coupled with the BCOM rebalancing on January 8th, raising the risk of a sharp pullback. Long-term conviction. However, the silver inventory crisis is a matter of public record. China's stocks are at decade lows, and supply gaps will persist until at least 2027. The gold-silver ratio has massive room for correction. The precious metals supercycle has only just begun. 2026 is destined to be an extraordinary year. We may see more volatility and more irrational moves. This is a game for the brave. What is the best move for us average investors? It's not about betting on every minute-by-minute wiggle, but seeing the macro trend and holding core assets. If silver sees a sharp correction over the next few weeks due to a dollar bounce or index rebalancing, don't panic. It might be your last and best ticket on board. Finally, I want to remind everyone, don't try to catch every single wave. Instead, keep your eyes on the direction of the tide. The market is always noisy, but you can choose to be the calm at the center of it. At the end of this year, watch your position sizing, set your stops, and then pour yourself a cup of tea to watch the drama unfold. This is the mindset of a mature investor. May everyone's journey be steady and prosperous. In this unpredictable market, I'm here to be your telescope and help you see the road ahead. Merry Christmas to everyone once again, and in 2026, let's get those gains together. If you found today's deep dive helpful, please make sure to subscribe, like, share, and hit that notification bell. It really helps the channel and ensures you don't miss the next chance to grow your wealth. This is the Gold Breakdown, and I'll see you in the next one.